Okay, welcome back to the Mastery Series on how to find and rate significant gaps. And so in this lesson, we're going to cover questions to consider. And so when you're thinking about gaps, you want to come from it from a framework of answering specific questions about the gap. And so let's look at the ones that we're going to cover. Where is the stock gapping from? So before the stock gapped, either after hours or you notice it before hours the following morning, where was the stock trading before it gapped? That will tell us a lot of information, which I'm going to share later. Where is it gapping to? So not only is it important to know where it's gapping from, maybe it's gapping from this long consolidation, built up demand, and then it gaps over that, but then where is it gapping to? We want to make sure that we have a really clear answer about where it's gapping to. The third question is this gap clearing a relevant supply area above or resistant area, or is it gapping down below a relevant demand area or a support area? And let me just clarify that. I always speak in terms of supply, which equals resistance, and demand, which equals support. So if you're used to support and resistance, it's just supply and demand. And also, I'm teaching this Mastery Series assuming that we're going to be talking about gap ups. So you just take everything that I'm saying and just reverse it for a significant gap down. So is the gap clearing relevant supply if it's gapping up? Fourth question, are traders trapped in the most recent short term? And I'm going to expand on all these in the next lesson, but it's another question that we want to have an answer to, which is in the very short term, in the days, hours, week before the stock gapped, are traders trapped? Is volume greater than average? Again, volume equals money. We want to participate where the big Wall Street money is participating. And so we want to make sure that we have adequate volume both for the time frame leading up to the gap, so the stock is tradable, so to speak. In other words, it already has, interest in it. But then also the day of the gap and even the pre-market of the morning of the gap. Is there significant interest in the stock? Is the volume greater than average? And then what are the indices doing? And I'm going to speak about that when we actually rate these gaps, about how is this gap relating to what the indices are doing. Okay, and we'll speak more about that. And then lastly, is there a void ahead? Now when I say the word void in my previous classes, students always ask me what that is. So a void is just really nothing but the area of old supply, which now becomes new demand, and the next overhead level of supply. That area in between supply and demand is a void. And so we want to make sure that we have a nice, clean, tradable void from a demand level to a supply level so that we can actually get paid on these significant gaps when we trade them. Now, there are two types of significant gaps, but I got to tell you that in the gap kind of community or the industry within the trading environment, gaps have really become cluttered. And they've become cluttered with a lot of names, people trying to rename gaps like, all these fancy names like continuation gap, retest gap, exhaustion gap, pivot gap, this type of gap, that type of gap. And we don't really need the fancy names to trade these gaps profitably. A gap is either professional or it's amateur. Let's just keep it simple, because really the primary answer as traders that we want to know, which is going to make us money, which is what probability is it based on this particular gap that the stock is likely from a probability standpoint to go higher, or that it's going to fill the gap or come back in. That's really the question that we want to have answered. The names of the gaps really are irrelevant. We just want to know if it's a professional gap or if it's an amateur gap. And those are the two gaps. The only two gaps that I really focus on are whether it's professional or amateur. So what is a professional gap? Well, a professional gap has a greater probability of continuing in the direction of the gap. Now, it applies, this continuation, this probability of continuing applies both to the day of the gap, but also in the short and immediate term following the gap. So it's not just the day of the gap, but there's a good probability that over the next couple of days to weeks that it's going to continue in that direction as well. And professional gaps provide very high probability trade setups for both day and swing trading. So you don't have to be a day trader to capitalize and profit from gaps. You can both be a day and or just an exclusively swing trader. They provide the same edge, just on a slightly different time frame. Now, an amateur gap, what is that? Well, an amateur gap has the probability, a greater probability of moving in the opposite direction of the gap. So if it's gapping up, the greater probability is that it's going to come back down. Again, it applies for both the day of the gap and for the short and intermediate term following the gap. And they provide very high probability trade setups for both day and swing traders alike. So when we come back, we're going to go into now how to actually rate these gaps so that we can determine whether or not they're professional or they're amateur. I'll see you shortly.